What is a stock? What is a stock? Good question. I love investments. I love talking investments. All right, I'm going to make a stock certificate. I'm going to make a stock certificate for the eraser company. So if I want to start a company, one thing I can do is I can create an entity, I can create a corporation, and I can issue stocks. So I'm going to have an example where I'm going to create this eraser company, and I'm going to make erasers. So we will call it the Eraser Co. We're going to issue 100 shares. Generally, these corporations like McDonald's, whatever, they create millions of shares, or at least hundreds of thousands of shares. For an example, a simple example, I'm going to make 100 shares of stock, and they're going to be worth $1. $1. This gets a little more complex, but we're going to stay out of it when we talk about face value of stock and market value of stock. We're not going to get into that. That's a little further advanced. But it'll be worth 1 share, and we're going to get into something called dividends, though. It will pay a 1% dividend. So this is my eraser making machine. It's no longer a pencil sharpener. This asset makes erasers, and it costs $100. All right. I want to start an eraser company. I create a corporation, create 100 shares of stock for $1. So when I sell all these, I'll have $100. I take my stock, sell it, get $100. I go buy this eraser machine, eraser making machine. It spits out erasers. I take my erasers to the stores. People buy them. I make money. And that's how the company makes money. That's how the company grows. Now, who owns this company? The answer is whoever owns the stock. Stock is direct ownership of an asset. Of a company. The company owns the asset. The stockholders own the company. All right, that's a stock. It pays a dividend. What is a dividend? A dividend pays you for owning the stock. So in this example, 1 share of stock will get 1 penny a year. Doesn't sound like a lot, but generally people aren't walking around buying $1 stocks. Dividends are nice. I like dividends. I personally cannot advise at all. If I could advise, I would say, like, I would never really recommend someone buy single shares of stock. They have these things called ETFs and mutual funds. They're kind of the same. For this video, they're essentially the same. A mutual fund is generally managed by someone to achieve a certain goal, like international stocks or dividend producing stocks or no dividend capital gain growth stocks. But I'll give you an example. This is my eraser company. I'm going to get rid of my asset. The eraser making machine goes away, and I have this eraser, a pencil company, a mechanical pencil company, another mechanical pencil company. I have a pen company. I have a clickable pen company, another clickable company. I have all these companies. So if this is my eraser making company, I also have all these different companies. Not only do I have pen and pencil and eraser companies, I have tech companies. I have phone making companies. I have car manufacturing companies, food companies. I have every single company, really, every industry, healthcare, tech, in my hand. In our eraser making company, I have all these companies in this cup. This cup would be the ETF. So say these are the largest 500 companies in the US stock market. the S&P 500. And I bought a S&P 500 ETF for $1. For $1. This costs $1. I'm going to have, a small little piece of every single company of the largest 500 companies in the S&P 500, okay? They're not all going to cost out $1. They're going to be less ownership, but I'm going to have the same amount of stock value. Instead of buying $1 worth of a single company, all right? Sorry, this is an eraser company. Let me find my eraser. Instead of having $1 in one company that makes erasers that could go bust, making my investment worthless, I'm going to have $1 in all these 500 companies. So if this goes bust, I still have 499 companies. The only difference is I'm going to have like half a penny in every single company worth $1. All right, where did I go? I lost my questions. What is a stock? That answers that. A stock is ownership. Owns companies. Stockholders own companies. Real quick, back to this, because I'm sure there's going to be someone in the comments that's like, it's not equally 500 bits of each stock. They're right. It's really too advanced. I wouldn't get into it, but I know someone might comment. Bigger companies get bigger shares. So you might get 20 cents in Tesla and 1/10 of a cent in some random food company. It's not worth getting into the weeds about. I just think there might be some guy on his keyboard in the comment section. Anyway, moving on. What is a bond? Good question. We're going back to my eraser making company. So you have stocks that we went over. Stocks are ownerships. And then you have bond. A bond is another financial instrument that a company can use to raise money. A bond is a loan. A bond is a form of debt. So we will have bond. When you hear bond, think IOU. You ever borrowed some money from a friend and they're a really good friend, they wouldn't have a problem with it. They're not there, so you write a little note like, hey, borrowed $5, I owe you $5. You leave it in their drawer where you found the money. A bond is the same thing. A bond is an IOU. I owe you money. So we'll use another dollar as well. So $1. And we're going to do the same rate. It's going to pay 1%. A bond doesn't pay a dividend. It pays interest, also called yield. But we're sticking to interest. A bond pays interest. I hope I spelled interest right. Bond, IOU one. And they have a term in years. 1 year or more. Anything under a year is generally called a bill, and it's from the U.S. government. We won't get there. Bond, that's a good point though. A bond can be sold by a government or a company. In this example, we're going with a company. But you can also buy bonds from the government. They're called like a risk-free rate because the government has the right to make money or get money from the Federal Reserve. Therefore, it can always pay its bonds. But in this example, we're going to use a bond for a corporation. Corporation, asset. Corporation owns the asset. Bond holders lend money to the corporation to buy assets. Bond, $1, 1% interest. So say you, the investor, were to buy this bond for $1 for 1 year. Did I put a year on there? 1 year. 1 year. Bond. You buy this for $1. You give your dollar to the eraser company. They give you this piece of paper. They have your dollar and 99 other dollars from 99 other people. And they take that money, that $100, they buy an asset owned by the corporation. This asset spits out erasers like crazy. The erasers are sold. That money, some of it, will be used in 1 year to pay back the bondholders that they owe, IOU. So they will be given $1 plus 1 penny in interest. That's a bond. It's a loan. Bondholders do not own the company. They do not own the asset. The company owns the asset. The stockholders own the company. Bondholders lend money to the company. Company pays that money back plus interest. A little too far advanced, more than you probably need to know, but if the company went into bankruptcy, generally the bondholders have the rights to any assets, not the stockholders. The stockholders own the company. They failed, they blew up. The stockholders generally get nothing. The bondholders come and they get first rights to assets. More than you need to know. What's next? What is an ETF? I'm just going to use Google for this one. An exchange-traded fund that holds many investments and trades like a stock. Mutual fund, ETF, for the most part, just think of them the same as this one thing. An ETF, the S&P 500 ETF, or a mutual fund that tracks, the S&P 500, think of them as the same for the most part. There are differences, but we're not going into them. We're just not for this video. Just to not leave curiosity, like you can buy an ETF that tracks oil if you just want to invest in oil or in salt or in sugar. It's just not worth going into. For the most part, if you bought a S&P 500 Indian ETF or a mutual fund that tracks the S&P 500, the top largest 500 companies in the domestic US stock market, you're buying this glass. You're not buying that stock that I ripped up and threw over here. You're not buying the stock of one company. You're buying a tiny sliver of that stock of the 500 companies in the cup. So you buy the glass. In the glass, you get a tiny little piece of every single company. So you still have stock in these companies. It's just it comes into one package to you. Here is the S&P 500. 500 tiny little shares of stock, ownership of all these companies in one product that costs, let's say, $1. Boom, ETF. Electronically traded fund. Mutual fund, electronically traded fund. They're both funds. All right. They also generally have like management fees, and it's very important to pay attention to that. Please look at like the Vanguard S&P 500 expense ratio. That's what it's called. Because I think Vanguard's is like 0.5% expense ratio. And that's so important. So please look at your expense ratios. Maybe use the Vanguard app as a benchmark because they tend to have very good expense ratios. That's very important. If you made 8% and your expense ratio is 2, you're only getting 6. You have 8% and your expense ratio is 0.5, you're going to keep 7.5. So that's important.